Happy holidays, everyone, and welcome to Quiver Financial's Market Minutes from the Boardroom for December 2021. And we've got an action-packed presentation for you today that you're not going to want to miss. In just a few seconds, I'll be joined by my esteemed colleagues Justin Singletary and Patrick Moorhead for a timely and important update on how financial markets are rounding out 2021 and starting 2022. And as Santa checks his list twice, there's a lot going on in financial markets. So make sure and join us to hear what we're seeing in markets like the stock market, interest rates, gold, the US dollar, and other commodities. And if you really want to stay informed, make sure and subscribe to Market Minutes from the Boardroom by visiting our website at quiverfinancial.com. Until next time, take care and enjoy the holiday season. So let's start off talking about interest rates, because I feel that interest rates has been like the number one story people got wrong.
Yeah, to say the least.
Well, I mean, why? I mean, have you been? What do you think?
Well, it's been, we've been talking about how, interest rates might be going the other direction rather than going up. The common, I would say, street cred, or what people are talking about, is that interest rates are going to be rising. In fact, they've been doing the opposite. So it's been fun to watch.
Yeah, and so here's a picture that we brought up in November that wanted to really bring this to your attention, because most of you, I'm assuming, are, when I mention interest rates, your biggest concern is, oh, what do I do if they rise? And does rising interest rates also bring in more inflation, or is it a sign of inflation? Does it cause inflation? There's all these questions around it. And what's amazing is that when you look at this particular chart that we put out in our November newsletter about the 10-year Treasury, so the 10-year Treasury is what everybody uses to bench like mortgage rates off of. So it's what we use in the markets as our benchmark. With all this rhetoric, you would think that the 10-year Treasury has been going higher, higher, and higher all year. And as you could see here, really since January, February, it's been stuck in a range. And this is what interest rates do, folks, is that they get stuck in a range, like here, between 1.25 to 1.75. And they get stuck in a range because the market assumes the economy is at a certain level. And then as economic news comes out, that level can change higher or lower, and it'll always trade in bands. If I showed you like a 20-year chart of interest rates, you'd see periods of time where we trade in these bands for years. So from that experience, it's pretty natural to assume that if you're going to hang around this midway line of interest rates, we got this channel between 1.25 and 1.75, that if we stay below that midline too much longer, it's probably going to become a magnet to that lower level, 1.25%. And this is in the face of, now folks, this is a chart just up to yesterday. And what did they say yesterday at the Fed meeting?
That they're going to be tapering a little bit more.
Yeah, they're going to be tapering. They're going to be raising rates next year. So based on that news, where would you expect this to be headed? I mean, based on that news, shouldn't this be going up towards 1.7?
That's what I think the common people would think.
That's what you think, but it's not.
Common sentiment.
It's not. So it's obviously not what you see.
But Kobe, why is that? What rates are they raising?
So it's a great question. So, Patrick's question, what rates are they raising? So the Federal Reserve is focused on what you call a very short-term rate. They cover an overnight rate that affects financial institutions. It really doesn't affect us as investors. But the idea is if they adjust there, they also adjust liquidity in markets. And they think that if you can push rates on the low end, that the rest of the rates will rise. But what we've learned since 2008 is that the Fed, when they've been doing that, they're basically pushing on a string, because the Fed's moving rates up. The market's interpretation is going to be, hey, that should slow the economy down. So what ends up happening in the bond market, the real players, the institutional players, the investors, they look at this different and they go, wait a second. If the Fed's going to raise rates and slow down the economy, then we actually have a greater risk in a year, 2 years, 3 years of a slower economy. So they actually start buying more long dated treasuries, 20-year and 30-year treasuries, which is counterintuitive to the normal person, but that's how Wall Street works. They're thinking way ahead of today's news. That's why you can't act on today's news.
Yep.
So Patrick, the Fed is controlling that short end. The real market, the real participants, the people that are actually like crunching the numbers and know what the hell they're doing, are playing in the 10-year and 20-year. So we believe that as we go forward, you're going to continue to see this range, 1.25 quarters, until we either get some information on the economy that is really robust and growing, and then maybe that range goes up into the 2% range, or maybe we slow down again and we go back below 1.25, and we range between 1 and 1.25. We'll see, but right now, what everybody's saying is not in the charts, as you could see there.
Yeah, I mean, if anything, we're starting to get more of a flattening
Yes.
in the 30-year.
Yes, and I'm going to get right into that, because here's why it matters to you guys. So, great. Hey, great. Interest rates. What do I really, if I'm not buying a house and I'm not refinancing, do I really care about interest rates? Well, if you're invested in markets and you have money that you're trying to put to work, yeah, it should be interesting to you, because what it means is that the rate sensitive items, which are also typically the more conservative investments, things like treasuries or things backed by real estate or even utility companies, those are considered to be more conservative income and growth investments. Doesn't mean they're safe. It just means they're more conservative than maybe a stock that's a emerging markets, right? So in this kind of environment, we would assume that those rate sensitive investments continue to have good support. So investors with the right risk tolerance in the right time frame should be able to allocate some money into these areas and feel comfortable that they're not going to get their face ripped off. And that would be very contrary to the news, because everybody's talking about inflation. You're going to think to yourself, those kinds of investments are going to be challenged based on old economic standards. What's more important to you guys watching, to you clients and people who are invested with Quiver Financial, is what it means for us is we have certain assets in our current models and portfolio that are rate sensitive. So for instance, this is an exchange traded fund, and this is not a recommendation whatsoever, but I'm just showing this as an example that this is an investment that should rise when interest rates go lower, and it should fall when interest rates go higher. So like everything, you want to be there at the right time. We shared this in our November newsletter. This pattern, you guys have seen us show this to you many times. These triangle patterns are basically this asset's just coiling up its energy, and eventually it's going to break out one way or the other. Usually the textbook tells you that when it breaks out, that direction becomes the new trend. So if this is going to break out above the red line, then as an investor, the assumption is, okay, in the next 6 months, maybe this thing continues to run higher towards 180. If it breaks below the green line, then maybe for the future, it starts to run lower towards 110. So it kind of gives you just basis of whether you should be in or out. So what's happened since November, the support line is held beautifully, and it's broken above that resistance level. It's now back testing, which is exactly what you want to see. When in these patterns, you want it to break out above. Oops, apologies. You want it to break out above and then come back and retest, then go on a run. So the next 2 weeks, as we end this year and go into January, this is something that we will be watching very closely, because if this is a true breakout, we want to be paying attention to it, because it'll be important for our accounts, and there'll be some actions that we can take that are good. If this becomes what we call a false breakout, because there's two sides to every coin. So if this becomes a situation where it's a head fake, well, we've got a line in the sand, this green line, that if this thing does break down, we have a discipline that whatever money that is at risk by this type of movement, we can start to adjust and move away. So that's how it pertains to people that are clients or that are interested in interest rate sensitive items. Is we're really at this great junction point where if you're paying attention, you may get a tell that gives you an idea of you could be invested in something for multiple months. Let's move on to the dollar. So this is our last newsletter. We started with the dollar. Nobody talks about the dollar. It's like the dollar is the one investment category that just totally gets forgotten. It's like peas in a dinner, right? The dollar is peas and carrots or something. Like gold is carrots and peas is the dollar. But it's really, really, really important to pay attention to, because the US dollar, it controls all kinds of cash flow around the whole globe. And so it's a really good tell for us to understand the health of the global economy. So think of the dollar like an EKG, where you can just, by understanding how those little wiggles work, you can get an understanding of how the different valves in the heart are pumping. So the dollar really gives us good insight on the internals. And what we had shared back in November is we had shared that this looked like the dollar was bottoming. And what it's bottoming against is the price of other global currencies, like the dollar compared to the euro, or the dollar compared to the Japanese yen. This particular graph is basically the dollar compared to the 6 major currencies around the globe. So if this is rising, it's basically telling us that the dollar is gaining strength against the yen, the euro, the Australian dollar, a basket of these things. So we had talked about that we broke above this line here that was resistance. It's green dotted. It became support. We wanted to see it break above this red dotted line to add confidence that this was really, truly, like possibly a investable bottom. So tradable bottom is, hey, I can buy it, own it for a few days, week, 2, get out. Investable bottom is I can put money to work for a longer period of time. I can invest in it. So here we are, the green line, we hurdled, no problem. That red line, guess what? We've broken out above it. Looks like we're retesting it. If that's the case, well, if you see a successful retest there and start to move back above this level, then all of a sudden our call on the dollar looks really interesting, because it will have effects. The dollar is like the tail that wags the dog, in the sense that sometimes dollar strength is a sign of market stress, like we just talked about, and then other times it's a cause of market stress, because as more people buy dollars, then what happens is these big international conglomerates that really benefit from a weaker dollar, the way they report earnings. We've seen times over the past 25 years, there's probably been 4 or 5 times I've seen where the dollar gained strength and it actually pulled back the earnings of companies, and it actually caused the stock market to have a little correction, temporary, but it can be one of those things that can mean multiple things. You just have to watch it as the news develops. Most people, the investments that you own, the stocks and bonds that you own, they usually don't perform well if there's too much dollar strength. And eventually, if you get enough dollar strength, you'll damper inflation, because you have to remember commodities are priced in dollars. So dollar strength tends to put a pressure on commodity prices. Normally, when dollar is rising like it has been, you do not want to be an investor in gold, silver, or oil. However, sometimes that's different. Right. Yeah, and we're going to see that in a second. So one way the Fed, they always talk about the Federal Reserve has like 2 tools, interest rates and this and that, but really they'd have more that people don't understand, and dollar strength is one of them. Like if the Fed doesn't want to raise rates, they can do things that increase dollar strength, and that almost starts to act like a little bit of a rate rise. Too much dollar strength, if you own a lot of commodities or emerging markets, those are the 2 asset categories I would say that are like dollar strength is the kryptonite. They're the most threatened by it. So you get this dichotomy where everybody's talking about inflation, go to commodities, right? And during inflationary times, but then now you got dollar strength. So, which one's right?
Right.
And that's where, it becomes that there's not a lot of hedges. So if you have a lot of risk in a portfolio, you can reach out to us. We'll tell you what to do with it. So really what it means for most of you, where most people are going to have an effect in this, is they're going to have some exposure to maybe gold or silver or a commodity like that, oil, for instance. We shared this chart in our November newsletter of gold over the last handful of years. And again, here's one of these triangle patterns like we saw in the interest rate market. And again, the rule book says that when this market breaks above or below, that is probably going to be the sign of the next trend. There's another part of that rule book in these patterns is that about 65, 70% of the time, when you have this asset rising and then it goes into this consolidation pattern, 60 to 70% of the time, it typically will break out higher. So most traders are really looking at this with the expectation of a breakout higher. But Justin, if something has a 60 or 70% chance of being what it is, what does that leave open?
The other 30 or 40% of wild and crazy.
Yeah.
Rastafarian.
Exactly. It leaves 30 to 40% of complete confusion and chaos.
Us.
Yes. Chaos because something's not acting like it's supposed to, right? But that's why you have these lines to create discipline. So what's happened in the last month and a half, or month, I should say? So support's held. Crazy. Gold broke out. Dollar broke out.
Yeah.
Does not make sense because normally if the dollar was as strong as we just saw in the last charts, I would have expected gold to be falling. And what's crazy about this is gold is broken higher at the same time that you have dollar strength. It looks like it's back testing here again. So a couple of things are going on here after this breakout is that, one, we're asking the question like, what the heck is going on, right? And it also makes us go, this is all kinds of weird because the last time I saw this kind of behavior that was on a more extended multi-month period. This is only a couple days we're seeing here. So this is all very early. But if this were to continue for months, I haven't seen that since 2008. And there was a period of time in 2008 where half the year gold was a great investment. The other half it lost. And then the other half of the year dollar was, and it was one of those crazy years that if you understood how to be in the dollar and gold at the right kind of pivot points, you did really well. And it was the only thing you could have done as an investor to make money because there wasn't many other things that were. So this is really, 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 really interesting. And so what does it mean to you? This is something we're going to watch really closely because if there is a risk off trade coming, if there is something changing in the market and we don't know it yet, and equities and the riskier parts of the market take a little breather, then we may see metals and the dollar both move higher. This is that kind of environment where you would get this wacky out of nature behavior. And so that would be something that nobody's expecting. And that creates an opportunity because it's a dislocation. And that's what we want to find as an investment opportunity. And this is a really big if, but if this happens, most investors aren't really going to know what to do because these correlations get really wacky and they're used to acting in a certain way. So,
beware.
Yeah, the other side is
beware.
Well, the other side is one of these assets could be a liar.
Let's hope so.
I mean, it could. I mean, Patrick, I know you would prefer that the dollar be a liar and that it would break down and give some of your alternatives a nice run, like gold, for instance. But that is one option is at some point one of these assets changes behavior. But right now it's really weird.
We go off of the trends that we've had for the last couple of years. There's always that 30% chance that neither one of them are a liar.
Yeah, the chaos and crisis part.
Yes.
So let's get into the equity market, and then we'll open this up for questions and answers. The equity market is what everybody cares about, and that's why we leave it for the last. But it's really important to remember as an investor that the equity and stock market is not the only investment out there. There's hundreds and thousands of other very good quality investments. It's not that I hate the stock market. It's just I always have to remind people that you got to think broader and bigger than just one thing, because sometimes that one thing doesn't work, and it's rare, but it happens. So in November, we shared this. We had talked about how the market had broken down this channel. So the rules are, folks, is that if the market stays in this channel, the short-term trend is higher. We already know the long-term trend is higher because it has been for 12 years, right? So what we're looking for as money managers that are managing risk is when that short-term trend breaks down, that should be a warning sign to professionals like us that, hey, okay, wait a second, let's be a little bit cautious about, should we be buying, should we be selling, something might be changing here. And then markets do this where they break down a little bit, but they don't sustain the breakdown, and then they just leap back up like this. And then they get a little short squeeze and pop. So you have to always monitor these things for us in real time. You guys that are clients that are watching, you don't have to do anything other than sit back and know that we're doing this. But nonetheless, this was interesting because we pointed it out that, hey, this was a potential breakdown that we want to be careful of. It turned out to be a false alarm. So what's it really, what we had pointed out in the November newsletter back then is also that as we're hitting these highs, this is a really historically interesting spot because this chart from our friends at MCM Technologies is a 100-year chart of the S&P 500. So this goes back to the Great Depression, and then you got everything in between. And this is what we call a 100-year channel, basically. So there's only been once before the Great Depression that we've tapped the high point of this channel. Behavior is typically after you do that, you get some kind of contraction. MCM, they drew these lines. I did not. So I'm not saying that this is what's in front of us. I'm just saying that it's really interesting that we tapped that, and then the market has been stalling because for the last 3, 4, 5, 6, 10, a while, folks, we've been talking about these wave counts. And to refresh your memory, bull markets will grow in 5 waves, and then they will have 3-wave contractions to kind of correct and buy time before the next leg higher. In 2018, we had hypothesized that we ended a 3rd wave and that we were in a 4th wave. 4th waves have a certain behavior, and this fit every ounce of that behavior. And in the midst of COVID, when everybody was extremely negative, right about this level, we said, hey, wait a second, this might be the end of the 4th wave. We got to be aware, because remember, April, May, June of last year, what were we doing? We were hunkered down. We were hoarding our toilet paper. We were telling nobody come over, or if you do, knock twice, otherwise I'm going to shoot you through the door. So there's all kinds of crazy crap going around. And so it's hard for people to even believe in the midst of a pandemic that the market could do what it just did. And that's how 5th waves become 5th waves. 5th waves are the ending wave because they run out of steam, like anything does going up a hill. So now we're experiencing in real life, like what could cause a market to really explode higher and then lose steam? Holy shit, a pandemic, right? So all of a sudden, this 5th wave has just been climbing. And folks, it ain't normal for a market to go from 2,500 to 4,500. Okay, that's almost a double, right? So if you got neighbors who are like, we're making so much money, remind them, hey, the last time that the stock market doubled in a year was never. Okay, yeah. So if people are betting on something that never happens happening again,
good luck.
I'll be happy to take their money.
Yeah.
So, so nonetheless, I do really believe that our wave counts are dead on. And if they're not, I'm going to be really embarrassed in the future. But nonetheless, we're coming to a point where us as equity investors have to be aware that there could be an end to the last 12 years and that we'll have a year or two where things aren't as great. So we're watching this very closely because as of yesterday and today, we're hovering right along that short-term line. And if we break down on a Friday like today, or even into next week, a holiday week, normally this market should rise back up to this line. That would be the normal behavior for a December. But if there is a change, and I'm not saying that this is happening, but what we're looking for to give us a signal that we can then run out to everybody and say, caution, 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 things are changing, is we're looking for a 5-wave pattern off the top. And I'm not saying that this is going to happen right now, but this is the behavior that we'll be looking for that will tell us, okay, now we can tell investors what to do next with their equities, which will be contrary probably than what most other people will be saying. At least I hope it is. All right, so let's wrap it up and talk about what this means for you for an equity perspective. I really think it's important that if you're taking any advice on equities, that it's really custom to your time frame and your risk tolerance. Now, that's a pretty common statement, but really more so now than ever before, because if you're going to need your money in the next 2, 3, 4 years, then you're going to want to be careful how much you deploy right at this moment. And if you're feeling really eager to make a lot of money right now, I would tell you be cautious to fall into that FOMO or fear of missing out kind of attitude, or get chasing things. You know, we've had some very interesting conversations the last month and a half with people about what they've done in their money, because a neighbor or because a so-and-so or somebody in their family was giving them a lot of, oh, you should be doing this, you should be doing that. Well, right now it's really important to keep a couple things in mind, which is what kind of money personality you are. And we're going to have a lot of stuff around this in the future, because some money personalities can handle more risk than others. And then you've really got to put your risk on a time scale, and also like a risk scale of 1 to 10. Clients, you've had that conversation with us, is, hey, your portfolio is either, you know, a 1 or a 5 or a 10 or a 6 or a 3, whatever it may be. So this is a really important time for people to be understanding where they are in these risk parameters and make sure they're comfortable with them within their personality and their needs. Also, keep in mind the herd, keep the herd to your advantage. What that means is the herd is the rest of the marketplace. You want to keep in mind that the best investors tend to be contrarian. There's the old adage, you know, be a buyer when everybody else is a seller, and a seller when everybody's a buyer, or with a Warren Buffett statement, that is that when everybody else is greedy, you should be fearful. And when everybody else is fearful, you should be greedy. So right now, it's pretty obvious that we're, you know, closer to this type of euphoria moment than a capitulating bottom time. So very important just to keep that in mind as you're making decisions. If you are going to buy equities, focus on cash flow, because if you get stuck owning something that's not going up in price, at least you get paid to wait. Think of that both with companies, are they earning money or not, as well as the overall investment strategy. And I do believe that investors that can pick sectors or they can pick certain names, that they're now going to have an advantage. For the last 5 or 6 years, people could buy and set it and forget it, or just buy indexes, and it really didn't matter. We're probably going to go into a period of time here where people who actually put some thoughtfulness into their strategy will have an advantage, and tactics will become very important. Again, if you're a client, if you're working with us already, you don't have to do anything other than sit back, relax, enjoy the holidays, because we'll be doing it for you.